Sanjay Rao, the product manager for Bloomberg, Barclays, Indices in Europe. And the focus there is fixed income. We have William Hobbs, CIO of Barclays Investment Solutions, with close to 20 years experience in the industry. And finally, Steffen Scheuble, CEO and founder of Solactive. Since 2007, they focused on tailor-made and multi-asset indexes. So when we're talking about the world of indices and benchmarks, there's always one statistic that always fascinates me. So when we look at all listed equities on exchanges, there's roughly 50,000, but indices, benchmarks that track those 50,000 equities, there's about 3.7 million. So that by far dwarfs the actual underlying that they're tracking. So Sanjay, you're right next to me, so it's perfect. I'm going to pick on you for this. 3.7 million. I mean, how does anyone possibly sort through that sum and actually find something that they want to track or benchmark themselves to?
Well, yeah, whenever I'm looking for a fund, it's actually almost impossible to really understand what's going on. But I think fundamentally, it's important to remember what an index is. It should be the reflection of the investable universe for a particular type of investment. So ultimately, it forms the level playing field around which an investor can decide whether an active manager is outperforming, whether a passive manager is effective at providing a beta. So it's fundamentally trying to represent the asset allocation for the investor. And that's what the most important part about choosing a benchmark is, making sure that you're clear about what your asset allocation is. And then once you're clear about that, it's about deciding what's a good provider of that. And for us, the core parts of that is making sure that you have a provider that has a strong governance process, and then the 5 pillars that we define as the basis of an index. So that would be data, pricing, analytics, research, and distribution. Once the combination of those two, clear understanding of what you want to get, and then a provider that has all of those pieces, I think that's the core to deciding what you're trying to invest in.
So I think that piece of defining or reflecting the market is really interesting. Steffen, sort of in the process of constructing indexes, which is it more, reflecting the market or defining the market?
Well, actually, it depends on the strategy. So first of all, in terms of the 3.7 million indices, yeah, it's relatively easy to get there. You just take the different versions. You take a price return, a net total return, a gross total return, and you take 5 currencies, and you immediately have 15 indices. Yeah. So the number is always quite popular to be out there. In terms of what is an index, I guess an index is from our perspective, it has 2 applications. The first one is really defining what is the market. Yeah? So at the end, really giving a definition, how are US equities performing as an example. And the second one is offering an investment tool, so actually building an index to be investable. Yeah? In most cases, for example, the S&P 500, to give one of the most popular indices out there, actually reflects both applications, but in some instances you've got really only for benchmarking purposes or for investment purposes, and then these 2 areas are dividing.
Well, so it's interesting you mentioned the S&P because, recently, a couple years ago, they decided not to include Snap because it doesn't have voting rights. I mean, well, from an investor perspective, do you think that most investors are judging these benchmarks correctly, or should they almost view them as, okay, the S&P isn't actually purely the US market because it does have this sort of discretion?
Well, I mean, there's a number of interesting points that the guys have raised, I think. And the first one is, I think, what you've got to think about benchmarks is I'm trying to hold as clean a mirror to my face as possible, not one that gives me a full head of hair or a muscly torso. As an investor, what I really need is an honest appraisal of how much skill I've got. Now, this is a very useful application for us for those of us who are trying to get private clients to invest. Because one of the big problems you have with a lot, particularly in this country, I think, is the kind of stock picking idea. I never get to find out just how bad I am as a stock picker, as an individual investor, unless I'm not, because my benchmarking is not as accurate as I could be. And then you get to the problem of actually selecting the benchmark, which Sanjay covered a little bit. And the problem is, and these guys have both touched on this, so even when you go to a particular factor, so the S&P or small cap US equities, and looking over the last 15 years, and if you look at the difference in performance between the S&P small cap 600 and the Russell 2000, it's about 3% per annum over that time frame. And if you dig a a little bit deeper, and this is where the due diligence comes in and how you select that benchmark, you find out that actually all across a number of factors they look quite similar, but because of the methodology for inclusion for the S&P version, there's a bit more of a focus on quality. And so you've always got to know exactly what you're buying underneath or exactly what you're comparing yourself to underneath, so you can give yourself that honest appraisal as an investor.
Do you think then a lot of managers are benchmarking themselves to the wrong index? Does that happen a lot?
Definitely, but it's getting better. Because of the work that these guys are doing, they're providing us with more accurate indices, and essentially our ability to check what factors managers are playing under the bonnet, whether they know it or not, is getting easier and easier and easier.
Right.
So we are being able to discern much more easily the actual genuine existence of skill rather than just a benchmarking problem.
I mean, Steffen, from your conversation with different investment managers, are you finding that they're doing a good job of choosing what is accurate for them?
I guess most of the people really do that. So I guess in the last couple of years there was a lot of focus on education. Yeah, there was a lot of regulatory push into transparency. So if you go today to the different index providers, you find the methodology, you find the constituents, sometimes delayed, but in general you find them. So you've got full transparency, and it's still the decision of the investment manager. Is what is available, is it the right one for me? But at least you have got the option to explore and to run a proper due diligence on the index, which is something that each and every investment manager should do.
Actually, to that point, I think distribution of information on the benchmarks has been, the growth of it is astronomical over the last 10 years. But one of the other things to remember is that the benchmark is a consensus opinion of what is the market beta. And it's about making sure that you have that conversation with investors about what they view as a particular important part of that market. And markets evolve. I mean, it's not a static process. So if you look at 15 years ago, when people were looking at international bond investing, they viewed investment grade as developed market, and there was no distinction between DM and EM. And as we progress through time with fundamentals in EM countries improving, we've seen that there's a bleed into investment grade debt from EM issuers. And how do you asset allocate across that? If you're doing it from an investor perspective, if you want a clean division of how you're allocating, then you need a clear understanding of your benchmark. So as our indexes have developed, we've had to define specifically what is EM, and then we've excluded them from our high yield indices on the domestic market. Because investors need to be able to have clarity as to where they're allocating and where the crossover is.
Is there still a lot of delay in accurate adoption of managers to tracking different bond indexes? There was a study by AQR a few years ago saying that the reason that a lot of credit investors look like they outperform is because they're piling in to credit, to high yield, and then you compare it to the ag. So of course it looks like they're outperforming on that basis.
Well, that's the important part of choosing the appropriate benchmark. So the benchmark itself can set the definition of risk. It's supposed to be the reflection of your risk-reward parameters. So if you've piled into high yield, that's not in the aggregate index. So ultimately, you've made an off-index bet. And maybe that's acceptable. The investor should define the parameters of what's acceptable. But fundamentally, you need to be clear about what parameters you set, and that's what the index does very well.
Well, you're nodding your head like maybe you see this a lot?
I love that article. It was really interesting. And as an old equity analyst, I used it to abuse my fixed income colleagues quite a lot in the office. And again, it's part of that point about exactly the same point as I made earlier, is that you need to be able to evaluate who you're buying and what you're paying for, and it helps you make a much more informed decision about the fees you pay. I mean, I'm sure we'll get onto fees in a minute, but this is really, it goes to the heart of it. I need to be able to judge skill.
And one of the other things that's interesting, as you have more indexes, more assets behind that index, is sort of the power of index providers when they include a new share, when they include Bloomberg, for example, including China in some of its indexes. Steffen, what are some of the effects on the market itself we see when a new share is added or a sovereign bond into indices?
Well, you start with the index, and the product is the next one. So the index is the basis. The index needs to follow strict rules. So each and everybody does not even need to know what is in today, but people also need to know what is in tomorrow. So that is the transparent, rule-based approach of indices. If you've got that, then actually you've got the product which is actually replicating the index. And of course, if you've got, let's say, China A is currently the most popular topic in that respect. If you include Chinese A shares into an index, then actually the funds following that index are buying these stocks. So actually you create demand for a specific, let's say, country, region, asset, whatever. Yeah. And of course, that is driving performance, because if you've got a shift from demand and supply, always that is reflected in the prices.
But I think there's your earlier point, whether an index defines or reflects the market. So fundamentally, I think it's supposed to reflect the market consensus of what's investable. If you take China inclusion in our Bloomberg Barclays aggregate indices, we have a governance process where for 20 years we've held panels in New York, London, Hong Kong or Singapore and Tokyo to discuss with investors what is the appropriate universe for each different asset class. And we've raised China 3 years running. Effectively, with every new program that the issuer had put to make the market more investable, QFII, RQFII and Bond Connect, they changed the structure of their market to incorporate themselves within the international markets. And it's a question of a conversation between ourselves and the investor and the issuer to try and understand, have they done enough to be able to deliver that? So given that there's a range of investors, types of investors like bulge bracket asset managers like Vanguard, smaller asset managers, and then you have asset owners. And then there's regional differences. Japan is passive, active in the US, and a mixture in Europe. It's a question of when does that consensus agree that China is eligible for access. And what we did was, having the conversations, we've made a decision based on that feedback that we think reflects the majority view. And what we've seen with inclusion is that it seems to do that. But there will be, to some extent, a small minority which is effectively being defined in the market by that inclusion.
And Will, in your conversation with investors, how much do they care about whether a share or a bond is included in an index?
Well, it's sort of a different. I was going to thinking about it from a different angle slightly, Dani. I mean, in a way, the points that the guys were making go to some. Indexes aren't static, or benchmarks aren't static, are they? They're always changing, evolving, and new companies are being put on and taken off, and countries in and out, so on and so on. And it makes it, in a sense, difficult for investors just to get the index. The whole idea of that if I buy a passive exposure to a benchmark, I get that benchmark. Of course, that's not entirely true. It's very complicated and difficult to get that benchmark performance exactly, because what you tend to find, IPOs, for instance, on average, the S&P over the last 20, 30 years, I think IPOs account for about 1%. Of the market capitalization. Now, if you assume that between primary and secondary listing, and the history bears this out a little bit, there's about a 10 to 20% discount, then there is an advantage, in a sense, for being a price-sensitive buyer. Now, that advantage isn't massive, that inefficiency isn't massive, but along with a number of other frictions, what it says to me is that although I'd agree very much with Sean Haggerty's point earlier about that passive exposure will increase in Europe in terms of investments, in terms of investors' portfolios, what you should find always is that there is a role for active management within those portfolios, but it's just at the moment it's being underused. Passive is being underused by particularly retail investors, and I think we need to get ourselves up to the sort of institutional levels of passive versus active exposure, and there's some way to go.
So, as the popularity increases and you do have this issue of index rebalancing, new members, Steffen, is there any way to take advantage of this? Or is index arbitrage so popular that there's nothing really left for most investors?
Well, actually, if you just follow, for example, the announcement of an index rebalancing of a very big, very popular index, you have immediately performance impacts. Yeah. So that is something that is quite evident if you just look into the S&P 500 rebalancing. If S&P announces these stocks go out, these stocks go in, then actually you cannot trade the stocks at the level prior to the announcement. Yeah? So at the end, once again, the funds are replicating these strategies. Yeah? And I guess what is quite interesting is we've done studies, and FTSE Russell, they've done studies as well. If you just shift the rebalance of an index a couple of weeks ahead, yeah. So you go away from the standard rebalancing that you're used to. You've got a performance impact between 5 and 15 basis points. Yeah. And that is quite interesting if we are thinking about the fee discussions that we are having. Does an ETF provider lower the fees from 6 to 4 basis points? Fine, but that performance impact is something that is quite important. And I guess that is something where a lot of additional education is needed to really demonstrate what are, and we call that the hidden costs of index rebalancings, what are really performance attributors.
So actually, in fixed income, I think that you can see the evolution of the market. So historically, the majority of usage was in active management. And most of the indices were 1 year plus. There was a noticeable effect as the rebalance came to the 1 year, and then bonds would drop out. There would be a drop in price, and then a move up as money market funds started buying the bonds. So there was a way of making money from that. But passive managers have started to look at that benchmark and look at that structure and say, well, actually, we'd prefer 0+ benchmarks. There's no reason for us to sell the bond. We might as well hold it to maturity. So there's a bifurcation in the market where an active manager is looking for a goal to be able to outperform with understands what they need, whereas the passive will look at a slightly different structure.
So this is probably a good time now, since you're talking about the advancement of fixed income or adoption, to get to our polling question. So if you guys want to start to bring out your phones. So we are talking about the future of ETFs, and of course, there need to be indexes behind for more advancements to come. So the question for this one is going to be, which asset class has the most room for index innovation? And so we have equity, fixed income, commodities, and alts. So yeah, again, which of these asset classes? I would be pretty surprised if it does end up being equity, since there seems to be a lot there. Well, 100% so far to fixed income. So Sanjay, your work is cut out for you. It looks like no one is putting in commodities. Never mind, 3% there. I mean, is anyone surprised by these results, or does this seem pretty in line with what you'd expect?
No, I mean, so I've been in fixed income more years than I'm willing to admit. We have always been the older, more boring brother of the equity indices. They've been more able to throw things at the wall, see what sticks.
Right.
But with transaction costs, liquidity, and various other factors, it's harder to do in fixed income. And so I think that's what we're seeing as well.
Yeah, Steffen?
Yeah, so I would just say, equities, we've got now 7%. Yeah. So I wouldn't be as skeptical as this one, because we should keep in mind we've got currently a huge trend coming to market, which is ESG. Yeah.
Right.
So if you talk about ESG, we've got probably 200 people here today. You've got 200 different opinions. What is ESG? And if you've got 200 opinions and 200 investors, you will end up with 200 different indices in theory. Yeah. The second topic I just want to raise, I'm very optimistic on fixed income as well, so that shouldn't sound negative in that respect. But investors also need to understand that if you generate 5 or 10 basis points outperformance in a smart beta strategy in fixed income, that is outstanding, whilst in equity, nobody would take care of that. Yeah? So investors also need to accept that smart beta and, let's say, small outperformance, small change in volatility is something that is already outstanding, and that is something that is missing from my perspective at the moment a little bit.
Will?
Nothing really to add from me, though. No, I mean, that all seems very logical. I mean, I look forward to more innovation in fixed income and so I can access it more.
How about this, Will? I mean, if you were to put yourself in these guys' shoes, I mean, you are obviously very in touch with what investors want. If you were, either Sanjay or Steffen, if there was an area that you would tell them to look into, that this is missing in the market in terms of a benchmark for managers, what would it be?
Do you know what? I don't think there's. I mean, from an equity standpoint, there's not much. I would say that we're going too far in one direction. And again, I'll go back to Sean's point earlier about there's the sort of thematic indices and ETFs that we're sort of getting more and more of. I'd worry more about that. What we really want is, like we go back to that first point, is just the most accurate mirror possible to hold up in each particular region, sector, so on and so on, so that I can always know whether what I pay for a manager is worth it.
I mean, and another thing that must come into consideration in terms of developing indexes and demand for indexes is what the market itself is doing. For example, we have, a massive bond rally, yields dropping to record lows in Germany, 2017 for the US. I mean, Sanjay, how does that impact demand for fixed income indexes?
Well, I think the structure of the market defines what people are looking to try and achieve. So we have a move to factor and style indices. We have moved to a carry indices. The idea that you can isolate a specific factor and then try and escalate that return. That's one of the things that we're working on in terms of our factor indices. And I think that's what's happened. There's a lot of looking at what's happened in the market and how can I offset that loss or risk.
Steffen, how are you seeing the market impact demand?
Well, actually, the market always drives demand of investors. Yeah? So the market environment today is a completely different one than 10 years ago, and of course that drives demand. So you currently see a lot of appetite for income strategies. If it's income on the equity side, if it's income on the fixed income side, so that's a huge and massive trend, and of course all different sorts of factors. In many cases combined with ESG. So these are probably the biggest trends we are currently seeing.
I mean, in those trends, more indexes coming to the market. I mean, I wonder if there's any sort of active manager frustration when it had like fads coming in that is distorting the market when you have all these more ETFs and indexes coming in because of, taking advantage of temporary market trends.
Well, I think it's more in the way that some of these exposures are confusing to investors. So we get the most common question we get from a range of investors is really sort of, I want to play artificial intelligence, or to Sean's point, I want to play obesity. How do I do it in a very concentrated format? And to these, a lot of investors, and a lot of the investors that we have are sort of successful entrepreneurs, and to their sort of mind, investing should be about concentration. Diversification is for wussies, just who lack conviction. And so in a sense, what we wouldn't want to do is to try and promote the idea that that's the way to do it. For instance, I would much rather have, the factor exposure is helpful, or the factor indices are helpful to us because they allow us, again, to isolate good and bad investment. But a lot of those thematic sort of indices that start coming out, I think that's just less helpful for consumers and more confusing and gives rise to more bad investment.
Interesting. I mean, Sanjay, what do you think about that?
To a certain extent, ultimately the index is trying to hold up that mirror to investors. So if that's what they're looking for, providing that is what we're supposed to be doing. The choice is theirs. It's about their asset allocation. So fundamentally, we would try to reflect what that mirror is as closely as possible. We don't want to give everyone more hair, but we do need to make sure that they can have the ability to choose from our perspective.
So unfortunately, we don't have much time left, but I don't think I can end the panel without just a quick discussion, as brief as we can, on costs. Obviously, ETFs fees dropping massively. Steffen, how do index providers help with that trend?
Well, actually, I guess we are to some extent at the forefront of that. So I don't want to dive too much into the details of my competitors, because otherwise I might be in trouble. Actually, the situation is, I guess, the ecosystem is changing. We've got a massive fee compression on the asset manager side, and that fee compression actually needs to be reflected on the index side as well. We personally believe that, first of all, there's an option for no asset-based fees, flat fees. That actually is what we are doing a lot, number one. Number two is the whole financial system has not really dived too much into what we call the power of data. Yeah? So actually, we believe there's a huge value in the data points that each and everybody of us is creating. We are leaving a lot of data at Alphabet and all the different companies and Facebook. It's a free of charge product, and they monetize on data. Yeah? So at the end, I think there's room that we can learn a lot from that. So we are aggressively pushing for that, and we all already mentioned that we believe that fees might go down below zero.